Too easy. Okay, guys, welcome to a new episode of Market Mastery. I'm here with TraderTroy, and we've also got some special guests here with us today from Wyckoff Analytics. And we've got Roman, who's going to be sharing a whole heap of stuff about their business, what they do, and yeah, a little bit of education on how Wyckoff works and what we can take away from that. So thanks a lot for joining us today, mate.
Well, thank you very much, Kyle, and thank you, Troy, as well. Troy has approached us and said, "Okay, we have a great community of traders who would like to know more about Wyckoff methodology, and we specialize in the Wyckoff method. Trading basically anything, from stocks to the cryptos to futures and so on and so forth." So go to our website, wyckoffanalytics.com, check us out. Just want to quickly tell you about who I am and who Alessia is. I've been a trader for over 25 years. I've been using Wyckoff methodology for the same amount of time. I started teaching this methodology in depth around 10 years ago, has taught thousands of classes and thousands of students. Our education came from Golden Gate University in San Francisco, where Henry O. Prudon, or Hank Prudon, was establishing those Wyckoff classes back in the early 1990s. So there is a whole legacy and background, as to who we are, where we coming from, what kind of knowledge we have, what kind of quality of knowledge we have, and so on and so forth. I'm not going to go into the depth of everything else, but just wanted to put this kind of like on the table so that you would guys know who we are. Alessio was our student for years, and he was just very advanced. So we invited him, into the content creation, and his interest in the cryptocurrency world was so big that he started analyzing the crypto assets for us and for our students using the Wyckoff methodology. So he'll have session
Nice.
number 2. I'm going to go through the basics today, introduce you to some of the concepts. Hopefully you will have some of the questions, some interest developing, around this methodology and more in-depth analysis, and we could just, have some follow-ups as well.
Okay,
All
great.
right.
Sounds good. Well, I mean, that's awesome because a lot of our guys, they also trade not just cryptocurrency markets, but they also look, gold, silver, especially the main indexes like the Dow Jones, SP 500 as well. So I think everyone's going to get a lot out of it.
Absolutely. All right, so let's look at the current market really quickly. This is the usual screen that I would have, for myself, and just going through this with my students. So let's look at the S&P 500. For those of you who trade this market, so we've been definitely in a very volatile, increased volatility environment, which is great for day trading, which is great for swing trading, which is great for long-term campaign trading as well. You just need to know who you are as a trader, know your method, and then just follow the trading plan and execution that you've established already. And
Yeah.
I'm assuming that that is already built in your community, and you know what I'm talking about.
Hmm.
The long-term case for me is still bullish. Why? Well, because we just overcame this important resistance, which was a long-term resistance that originated with the high in the pre-COVID decline. We have had a momentum run up where they were buying on the way down, and then they were buying on the way up. Then they run it into the first intermediate climactic action, had an apex formation. Some supply comes in, but supply is diminishing and is being absorbed. And then continuation. And we're commenting really heavily on how we're going to have an all-time high as we were coming out of this area right here. And all of the PNF counts were showing to us an area between 34 and 3,500. So a climactic run into the end of this rally, overthrow, overbought condition, suggesting that if we're going to have some kind of reversal, we're going to change the environment from uptrending into a trading range. So on this particular day, actually on the intraday break of this bar, the call was that we're done. We're done with this move, at least temporarily. But the positive was that we overcame this all-time high. Now let's look really quickly at the nature or at the character with which the price moves down. So aggressive spread to the upside, kind of reminiscent of what we had here. And then look at this high low. We didn't have that. We went into the low. But supply signature was not necessarily as high as we've had before. And then supply actually started to diminish. Also, look at the characteristics of the spread. The spread is diminishing, so that suggests less selling. We also see some tails, 1, 2, 3, and then the retest, which was a low on S&P, but still no follow through to the downside on the diminishing supply character here. So therefore, some indication that we are going to have some kind of rally. And the next call that we made was around this area right here, just saying that we are experiencing a change of behavior and a potential rally is going to come. Now, whenever we say that there is a change of behavior, there is some kind of reversal, we're expecting some kind of rally. It doesn't necessarily mean that that's it. We're going to go and, create a new all-time high. Wyckoffans always pay attention to the character with which the price moves and the character of the volume of that move. And we could start seeing here that, yeah, there is definitely some demand. So there is some pickup, institutional buying. We saw that most recent bars, like this bar right here, where we see the increase in the volume signature, had both increase of supply and increase of demand. And that showed us that absorption is actually happening at this bar and suggested some kind of continuation. But more importantly, this bar right here, this capitulation bar to the downside, where we have a small trading range, stop in climactic action. This is the level that we need to overcome. And on the S&P, we're still not there. And today's reaction to the stimulus package that was not deliverable today, produces some kind of bearish undertone for today's session. Now, please note that it doesn't really go below the previous bar. So that's a bullish sign. As long as we keep, going into tomorrow without actually committing to the downside, but more recovering from here, this would be extremely bullish. We also could have a reaction here back to this support line. And actually, it would make a lot of sense, because if we would look at much larger formation where we stop, this is where we could stop again. So again, this is an unfolding picture. This is not a really linear way of how we look at things. One other or a couple of things here for other indices. This was a very interesting day for NASDAQ because it started to outperform S&P, where we see S&P committing to the downside. NASDAQ actually had a day that was closing favorably into the body of the previous trading range. That showed strength, and that suggested an outperformance. And we see how NASDAQ outperformed S&P on the way up. Actually, in fact, and NASDAQ has touched the resistance much faster than S&P. S&P has done this on the intraday basis only today. So that was also a very interesting selection call that we did. And most recently, the strength came into small stocks, into Russell 2000. So an area of absorption that we could see here in the middle of the range. And this is a linear regression channel right here. I love using those, and Alessio uses those a lot as well. So we could see how absorption has happened at this level, and that was on the background of strength. And that suggested, again, continuation of the outperformance. So again, a selection call here, and look how nicely we are already at the August highs, whereas obviously both NASDAQ and S&P are still there. So this is a very quick market analysis. Troy and Kyle, if you have any questions before I go into some other market analysis, anything that attracts your eye, any questions here?
Yeah, so you said right at the start that you're expecting more bullish action to the upside post this next move.
Long term, right? So
okay.
when we talk about any type of calls, what's important is to understand what kind of time frame are we talking about? Are we talking about intraday bullish call? Are we talking about a swing bullish call, or are we talking about the long-term bullish call?
Yeah.
So to me, I'm looking at the long-term campaign call, which is still to the upside. And currently intermediate environment is a trading range.
Yeah, yeah. Nice. So sounds good. I love the way you see the market and analyze it. It's great. Troy, do
All
you have
right.
any questions?
Well, you could actually use an actual linear regression tool. So here on TradingView, let me just quickly find it. Always have trouble, just looking at this. Where is it? Next one up. Okay. Yeah, right here. Yeah. So you could basically do this. And the way how I do this is just when you look at the price structure, let's say trading range specifically, you go from phase A into potential phase C, and then you kind of create that channel and just shows you what you already see with your naked eye. And with my students, I usually would like to train them to see everything with their naked eye. You could use the tools, that's perfectly fine. So we see a high here, we see a high low. So therefore right away you will know that the channel is upsloping and the tool is showing you that upslope. Okay, very useful tool, by the way, because you could use this on trends and on trading ranges. All right, well, with this, let me just kind of show you also some of the techniques that I used or we used in identification of the most current price action. So here's a NASDAQ 1 hour chart, and it goes to September 2nd top, where we had this first big change of behavior. And right here, this was the call. The call was that we are done with at least the most recent move up. And after the change of behavior, that is suggestive of the trading range action, we are expecting some kind of reaction and then a stop in action. So the key was to identify a change of conditions that came right here. That was on the shortening of the thrust, from this low to this low and then to this low. We definitely see less selling than what we've seen before. We also see that there is some buying off the bottom. And actually, I tweeted this call right as it was happening. Like, this was the actual chart that was tweeted out on the September 24th. And we said that there is some buying under the in the background of the conditions that are oversold conditions. So there is a potential change of behavior, and we could start looking at some of the positions to the upside and add to those positions. One other thing that I really like doing, and I think the Troy or Kyle kind of mentioned this, that you also exposing, analogs or fractal type of models to your group as well. This is an 2016 election cycle, and we're looking at almost the same price structure where we have a decline into the COVID. Please note the volume signature, increase and then decrease of the supply into the low. The COVID reaction had more momentum, so you have lower lows, but still the volume signature is the same. Momentum takeoff rally, which still has some institutional buying behind it. And then we go into somewhat of the consolidation. Now, in the most recent price action, that consolidation was more upsloping, which is resumed by the rally and into a change of behavior. And this is a really important concept that we study with our students. Change of behavior and change of character. Those are two different concepts. But change of behavior is going to show you that the volume behaves differently, and then the price starts to behave differently relative to what we've seen in the previous rally. And that usually suggests a change of environment from, let's say, a rally to a trading range. And that's how it happened into the election in 2016. And that's how it kind of is happening, at least right now. We're somewhere here, and we still have some time to go, actually in October, somewhere here. So we have around a month to go. So we'll have to see how this analog will unfold. But just based on our understanding of how Wyckoff price structure unfolds and using this as an analog, we could anticipate a specific behavior of the price and specific behavior of the volume signature. Now, when you think about Wyckoff, you usually think, okay, well, Wyckoff defines the bias really well. You could use tape reading, to do that. But in fact, I always push our students to think much deeper and be much, much deeper thinkers about how the market works and how the price structure unfolds. You have to understand also the timing of when the price is actually leaving the trading range, and also the character with which the price is going to go either up or down. All right, another analog that I love so much, and I've been using this for a long time. Actually, the first time when we started using this analog was right here. So imagine if you would have that type of, analog to go for. So this is S&P. I'm using Autodesk here, but I could have used another stock because there are quite a few stocks in that particular area of the recovery from 2008 to 2009 low. They recovered in the same price structural way. So what happens here? Well, you could go yourself through all of these numbers. They're going to be very descriptive, but just picking up here at point number 9, we are finishing an intermediate climactic action, same in the S&P. We're going into the apex formation, same on the S&P. And then this analog is suggesting an attempt to come to the all-time high. Well, we know that S&P was a little bit stronger structurally than Autodesk at that time. So our call was that not only we're going to touch it, it's going to overcome. And we're going to have this last leg, of the uptrend into the all-time high again. And that happened exactly in that way. And then after that, we would be expecting somewhat of a more significant change of character than we've seen before. And obviously, this is not updated, so we were somewhere here. This reaction right here was the largest reaction that we've seen on the way up, and that suggested that currently we are in some kind of trading range environment. So just combining these two tools, the Wyckoff price structural analysis and analogs of fractal nature of how the market works, just based on the institutional behavior, allows us to to create this type of the analysis. All right. Well, with that, guys, do you have more questions at this point? Okay, great. So let's just go into some free offerings that we have. I mentioned that Alessio and I, are producing this about 30-minute video each week. This is a free offering, at least for now, on crypto analysis, where Alessio is bringing up a lot of charts that he looks at on the daily, weekly basis, and we just analyze them from the Wyckofian point of view. So hopefully Troy and Kyle will hook you up with this free offering. Check it out. Always very exciting to do this each week. Alessio on his own is also producing and has been producing, this is already a volume 37, Wyckoff Crypto Report. You could find it on our website. Just unbelievable knowledge and application to the crypto market based on the Wyckoff methodology. So definitely check this out. All right, well, let's just talk about the methodology itself, right? So what is it about, and how could we practically use it? So just to be very quick on the history of the methodology. So it was created by Richard DeMille Wyckoff, who was an editor of the Wall Street magazine of Wall Street. That magazine no longer exists. I believe it went out of publishing in 1974, but he was an editor of that magazine until he lost the rights to this publication to his second wife. That was his worst trade ever, to give up such a valuable asset. Unfortunately, the way how it unfolded, he kind of was tricked into that. He before dying, passing away in 1934, he has compiled together a course, which we say is an original Wyckoff course, literally years before he passed away. And a lot of our knowledge came from that course, and then that course was developed even more by Bob Evans, his student, and by many other people in the lineage, Wyckoff lineage, and we're just very proud, to kind of like sustain uh, that knowledge, sustain that legacy. And obviously Hank Pruden, of Golden Gate University, was just an immense pioneer and cheerleader of the methodology. He was deeply involved in the teachings of the method, and I became his a student in 1996, and from that point on I'm just like a lifetime Wyckoffian. He had connections with the stock operators at that time. Actually, one of his friends, colleagues, was Jesse Livermore, and they had multiple discussions about how the market works and how the stock operators worked at that time. And obviously, it's so different from what we have right now, but the principles are going to be the same. And the principles right now is that institutions have to make money in the market, and they're going to do this in a very specific way. And if we could, on the chart, see their footsteps, we will know what the market is going to do, because those big institutional money is usually going to be more correct than not about the direction, the timing, and the overall extension of the move. Wyckoff codified the principles, the concepts as to how stock operators did it at his time, and we are adopting those principles and updating those principles to the current market environment. And it's just a lot of fun, to do exactly that. One of the concepts that Wyckoff has used is their idea of the composite operator. So who is the composite operator? Well, this is a piece that I absolutely love. This is from the magazine of Wall Street, and I mentioned that Wyckoff actually was an editor of this magazine, and it's been written by Richard D. Wyckoff himself. It's on the composite man. I want to point your attention to this paragraph right here. Who is the composite man, and where can he be found? He consists of some 2 million personalities. So at the time of this writing, that's probably was a reference to the number of traders, even like around the world, scattered over the face of the earth. Some of his components parts are richer, more powerful than others. So those are big institutions, and that's how he's just liberally describing those. Some are noted for their foresight, intuition, shrewdness, conservatives. So those are probably analysts, that would analyze the market and would be on the correct side of the market. Some for the dashing, daring, reckless quality of their moves. Those are speculators. And speculators, as you know, are going to be on the right side of the trade many times, and sometimes they will not be. These millions of personalities form one omniscient who sways the market, crushing those who don't know. So they have big size, and big size dictates what the price is going to do. If there is more demand, the price will go up. If there is more supply, the price will go down, and will not learn how to benefit by him and crowning with the profits and income those who do. So it's a collection. Composite man is a collection. It's a heuristic that we use to identify the correct smart hands in this particular trade, and the ones that are going to accumulate the shares and hold on to their shares throughout the whole cycle as the price goes from the accumulation into the markup, through multiple reaccumulation areas, and into the distribution, and then finally into the downtrend. So a very interesting concept and very important concept in the methodology for us to think about. All right, let's talk about the price cycle now. Well, first of all, I want our students to understand who are the market participants, and we go into a lot of depth as to who are strong hands, who are weak hands. And it's very important, and I call this the behavioral market analysis, to understand that institutions are people like us, skin and bones, and so therefore they're going to have the same emotional landscape as we are, and they're going to make mistakes. But at the same time, they operate in a different way. They have specific intentions and specific goals and specific limitations that they have. So their behavior in the market is going to be, very much set in one way. And that creates a herd mentality with the institutions. And that's what creates like this big, big size. It's not just one institution. It's not just Warren Buffett that drives the market. It's multiple Warren Buffetts around the world that actually see what they see in a current market structure and therefore behaving in the same way, and that creates a specific structure. Well, our first definition of market participants is very simple. We're going to look at the strong hands and weak hands. And usually at the beginning of the price cycle, which starts with the downtrend and with the stop in action that would be identified as the climactic sell-in climax type of action, the weak hands are going to be at the extreme point of fear and capitulation. This is where they're going to say, get me out of this position no matter what. I am tired emotionally looking at my losses and I need to fix this right now. So sell it at any price. Well, that type of mentality and again, the herding mentality of the weak hands is going to create a climactic run, which is going to be associated with increased momentum, with the downward spread increasing a lot, with some downward gaps, with the volume signature increase that is going to be massive. And that's a typical characteristics of, those are typical characteristics for the climactic action. Now, at the same time, institutions that are strong hand institutions that are going to trade in harmony with the price cycle, they see this as an opportunity to start accumulating their positions. Well, and the question here, which would be a very relevant question, why wouldn't they do this at the beginning of the uptrend? Well, because of two reasons. Their size is just too enormous, and they have to come in into the position where there is some liquidity behind the price action. They also need to come in into the position where they see some kind of long-term value proposition. And as they're thinking that, or their models, their systems are showing that in the future, when the price cycle is going to unfold, and it could take years, and they don't invest into a swing trade. They're not going to stay in the position for a month or 2 or 3 or even 6. They're going to invest for a long haul. They're going to think about the industry group. They're going to think about the overall economy, the macro picture, and they're going to say, for the next 2, 3, 4, 5 years, we're going to have favorable conditions to accumulate shares and not to distribute those. And therefore, at the point of long-term value, they're going to come in, and at the point of the liquidity, they're going to start originating sizable positions. And that's why at the beginning of the trading range, we have a stop in action. We still have a high volatility going even into the early phase B. And that kind of defines the character of what I sometimes tell my students, the texture of the price and the volume signature. And those are the times when the first signs of intelligent accumulation are being shown by the strong hands. Well, as we go through the trading range, and as Wyckoffians, we definitely want to differentiate between different phases. We want to understand the characteristics of the phases. We want to understand the Wyckoff events of the phases. That will give us not only the definition of the bias, but also the definition of the timing. And also, we will start having some glimpses as to what kind of potential character of the uptrend we could have. Now, the next step is also very important. As the weak hands go through the selling climactic run to the downside, and then through the trading range, they are getting exhausted by all of the losses and the trades that accumulate throughout the trading range. So they tend to withdraw, and as they withdraw, they become inactive, and that diminishing the supply signature. And whatever supply increase we have into the end of the trading formation are going to pick up by those big institutions that we call, heuristically a composite man. And as they pick up this last supply, the price starts making higher highs, higher lows, and we start seeing the emergence of the uptrend. Now, this is a very important point because there are different type of institutions that I've mentioned. Again, if you want to study this more in details, you can just come to our classes, and I'll present you with that material. So this type of institutions, let's just call them, institutional momentum followers or trend followers, their systems are going to find the new uptrend emerging in this area, and they're going to start jumping on this ship because they want to identify the trend as early as possible, and they want to ride the trend in a sustainable manner until they see the signs of the distribution. And with that, what this produces is more absorption of the supply, and then the trend becomes more sustainable. It's into the area of the excitement by weekends. This is where the first signs of intelligent distribution will happen. The institutions that were buying somewhere here at the climactic action will be selling into the buying climax. In fact, it's their selling that will define the stopping action, that will define the buying climax itself. And then we could see how weekends are profiting, they're excited, and as we have a change of behavior that is going to suggest a trading range environment, this is where weekends are going to be very, very busy operating, thinking that there is some kind of short-term value and they're going to jump on the ship. But obviously, throughout the whole trading range, CO is just going to sell into the strength, and then that will start producing some kind of deterioration of the uptrend, in general deterioration of the trading range structure, and this is where we're going to see the emergence of a downtrend. And we just want to catch this process, whether this is accumulation or whether this is a distribution, whether this is in a reaccumulation or whether this is a redistribution. We want to understand where the trend ends. That's number one. What are the characteristics of the ending action? What would be the first sign for us to say that the environment has changed from trending environment to a non-trending environment to a trading range? And then how does the trading range unfold? And what would be the bias of that trading range, and what would be the timing when the price is going to get out of this trading range? If we have that type of information, we could jump on the trend early on. We don't necessarily, looking for tops and bottoms. We're looking for areas where the trend changes or where the trading range environment changes. And that's the whole goal behind the methodology. All right. Well, you probably have seen this. This is something that I've created, these two schematics I've created for stock charts, and they kind of become, somewhat popular within Wyckoff students. And there are some improvements that I've made even to the stock charts version of it. So this is a little bit more of the updated version that I teach in our classes. Wyckoff would describe trading ranges through Wyckoff events and Wyckoff phases. You could see here phase A, phase B, phase C, phase D, phase E. Each phase has a specific intention. For instance, phase A has an intention of stopping the downtrend. And through this phase, we could observe different Wyckoff events like preliminary support, the first attempt by the institutions to stop the downtrend, which always will fail. Climactic action, this is where institutions are heavy buyers, and I'm talking about Warren Buffett type of institutions, that have billions of dollars, and they're willing to come in as the price goes down, and they do that without fear, just because the value, long-term value, is there for them, and there is liquidity, enough liquidity for them, to come in and to establish a meaningful position. As they do so, the next rally, which is an automatic rally, will produce a change of behavior. This is where the price action and the volume action could be observed in a different way of the rallies that we've seen in the downtrend. That is suggestive of the change of environment from a downtrend into a trading range. We still will have to define the bias. We'll still have to define the timing. We still will have to define the character with which the price will move out of the trading range. But it's an extremely valuable tool for us to think of how environment changes. And multiple trading decisions, tactical trading decisions, will be based on that change of behavior. Now, phase A is going to be concluded by the test, secondary test. In some instances, a change of behavior will happen, and then there is some kind of continuation of the downtrend. So that's why secondary test is extremely important, because it confirms that now structurally we have a change of character. From a downtrending environment, we're going into a trading range. And now we could just concentrate on the bias, and we could concentrate on the phases themselves. Phase B is going to be all about course building, kind of like sometimes I call this a war between supply and demand. There is still not a unified, homogeneous consensus as to what bias we are in, accumulation, distribution. So there's some volatility that's going to be persistent in the early phase B. But then if we're in the accumulation pattern, usually that volatility is going to diminish, and we're going to have a local increase in the volatility going into phase C. Phase C intention is all about testing the supply at the previous stopping actions in phases A and B. So if that supply is being consumed by the CO going into phase C, we're going to have some kind of quick recovery back into the trading range above the support line. And that would act also as a confirmation for us that potential phase C has unfolded. The next confirmation will be a major sign of strength. This is another change of behavior where the rallies now are behaving in a different way than in the current environment. And we're saying, if this is a change of behavior, we need to see a structural change, a change of character. That will come after the confirmation by the backing up action, where the reaction is going to be the flattest reaction or the smallest reaction in the trading range. This action right here will, which we call a change of character, a combination of the rally and the reaction that is better than any of the rallies and the reactions in the trading range, will suggest that the emergence of the uptrend is in place, and that this zone right here would be considered our, zone for buying. We could go through the distribution here, but the logic is going to be the same. The distribution is going to have specific nuances, details that are going to be slightly different than accumulation. But yet the concept of the big institutional composite operator man selling into the excitement by weekends, into the buying climax, producing the reaction that is the largest reaction in the uptrend since the last upswing. That change of behavior would suggest that we potentially could go into a trading range, which we will have again to define the bias, the timing, and then the character as well. Now, the trading range is going to be confirmed by the secondary test failure in the phase B. So early on in the trading range, we could define, not only the environment that we are in, consolidation, but also the boundaries of the trading range. Put the resistance and support lines, and that Wyckoff tool was, and is very, very helpful for us to define, where the price is going to consolidate. The Wyckoff events and the distribution are somewhat a mirror image of the accumulation. Instead of a secondary test, we might have upthrust. Instead of, let's say, a spring or a shakeout or last point of support, we will have, either an upthrust after distribution or a last point of supply. But again, as I mentioned, the principles on the way into the trading range and on the way out are going to be the same. On the way out, we're going to produce a change of behavior, which is going to be confirmed by the next rally into the eye, so into the resistance that acted before as the support. And then once that happens, we know that, well, we are done with the trading range environment, and now we're going to be in the downtrend. So all of this is going to be our sell zone, Wyckoff sell zone, where we want to either close our long-term campaign positions or maybe swing positions, and if we were pulled in into some of the buys right here, and then establishing some short positions, in this area as well. Okay, another free offering. And actually, I have to go back to Troy and Kyle, and let's just see if we have any questions here. I'm trying to squeeze in as much material as possible. And if I'm going really fast, just stop the recording and just re-listen. But Troy, Kyle, any questions? Yep. Yeah, absolutely. Absolutely. Yes. So obviously the UDOT itself, or any type of upthrust, if we would talk about definition of the upthrust, so the definition that I give to my student on the upthrust is a temporary commitment above and almost instant comeback into the trading range below the line of the resistance. That is how upthrust function. That's the definition of the upthrust. Where would the upthrust be confirmed that indeed this is an upthrust? Well, on the failure of the upthrust, this is where the price comes back below the resistance, maybe after multiple tests. And obviously, we want to understand the character with which the upthrust occurs. We want to understand the character of the price movement to the upside. In some instances, we could have the deterioration of the price momentum. That's number one. Then we would be expecting some kind of reaction, and with the more strength, more aggression. We could also have what I call a second point of excitement. If we had the first point of excitement into the buying climax high, then the second point of excitement in phase C into the upthrust after distribution will have, one or two or several up bars that will look like a bullish case, a bullish breakout. And it might have some increase in demand signature, but it's not going to be as much, let's say, on the climactic action itself. So once we go through those characteristics and we see how the price starts to fail, and that failure usually will happen also in the increased supply signature, that's when we know that this was indeed an upthrust. It's confirmed. And actually, this is one of the best point of entries for the distributional formation. It's that failure of the upthrust. Why? Because usually these people that are getting into this position based on their idea that this could be a potential reaccumulation, this could be a potential breakout and continuation. Once upthrust starts to fail, they're going to give up on these positions gradually, and as we go through their stop losses, this is increasing the volume size, and it increasing also the aggressiveness of the price movement itself. Good question. All right, anything else?
Mine question was pretty similar, actually, so don't think we need to double up. But I mean, the major thing that I think our guys struggle with is identifying if something is a continuation pattern, so like a reaccumulation or a redistribution, or if it's actually going to end up reversing and being an actual accumulation or distribution patterns.
Right, and I think that this deserves its own kind of like attention, and almost like a class of its own, because there are so many characteristics and nuances, details, variations on how reaccumulation could be created, right? So we could have a reaccumulation that could have a downsloping structure. So we would be looking at the uptrend and then the price consolidates. We could have a reaccumulation that would be upsloping, and we've just talked about the linear regression channel. We could have a reaccumulation that is going to be very, very quick. So there are quite a few structural variations and obviously volume variations that we would need to consider. So maybe another session, a follow-up, but definitely would be happy to explain this to a certain degree. And obviously, for those of you who are much more serious about, Wyckoff methodology, you have to study it properly. So just, come to, experts, classes, that you consider, beneficial to you. We'll be happy, to have you. And I'm not necessarily, promoting, oh, come to us. No, study anywhere. My passion is just being a teacher and being a trader. I always say that trading is my craft, teaching is my passion. So you kind of, have to go out there and to study with others and then come back to us and see what we do, so that you would have some kind of comparative analysis. Well, I've mentioned Bruce Fraser. So Bruce was actually one of the original teachers at Golden Gate University that helped out Hank Pruden to create the original curriculum on Wyckoff method. He is a blogger on StockCharts TV and on StockCharts.com. He has his power charting episodes each week, so go check this out. I've mentioned to Troy and Kyle that all of my trades, or at least, the majority of them, or at least the majority of my mistakes, I go and discuss with our content contributor, Franz, in the weekly video update, Anatomy of the Trade. Check out our channel, which is called the Wyckoff Trading Method channel. So we have quite a few videos there. All of those are educational. Also, a very popular tool, educational tool that we've developed at Wyckoff Analytics is the bias game. So obviously, just looking at the trading range and thinking about all of the principles behind the price action and the volume characteristics, you should be able to see what's going on in terms of the buying and selling, and you should make those type of judgments routinely as to the bias of the formation. What should happen next? Would the price go up? Would the price consolidate? Would the price go down? So this is a game that we've developed for our community. You could vote on Twitter. Our handle is at Wyckoff Analysis. Each week we have that game on, so you could see how the people are voting for this particular game. This was actually good because people said it's an accumulation, and PayPal here obviously had a lot of accumulation elements. We explain and we label the chart for our students. Why is this important? Well, because you have to not just guess what this is, or you have to intellectually come to the solution and to understand why you're labeling this way, why you're seeing this analysis and you think that this is an accumulation. Why do you think that this is a good selection candidate? Why do you think that the timing is now? Why do you think that the price is going to accelerate? So all of that we explain in our Wyckoff story each time we go through the bias game. All right. Well, a lot of questions usually come to me around, COVID-19 decline and the current rally, and just to kind of like show you how we went through that, or some specific calls that we made. And we have to start with the 1919, where we basically were saying that we have a confirmation now. Please note that we are saying that the count is complete. The PNF count is complete. We're talking about this PNF count. Why? Well, because there is a specific technique that would define to us where the timing actually is for the price to start moving. So this particular horizontal counting technique showed us on the trade count that we are looking for 3,500. And then on the campaign count, which was taken from the low of December 2018 into the low of February 2018, and showing approximately the same count. Those are confirming counts. And this is what we actually want to see from our PNF work. And we said that the timing is now, the bias is to the upside, and our target is about 3,500. All right. Well, as we go there, again, I mentioned that I love using analogs. So look into the analog of the composite from 1998-99. The price structure unfolds in the same way. First, a change of behavior, then an area of absorption that leads into the overthrow condition in phase B, and then have a decline that has an ABC or 1, 2, 3 type of structure where there is a distributional pattern in the middle. Out of that low, which we definitely could label as a shakeout or a spring, we have a substantial rally that takes us in 1999 to the new high. Now here we did not produce a new high. This tells us that the analog is a little bit weaker, and we could expect the second leg up not as extensive as we had in 99 into 2000 top. But what we could expect with this type of the increased momentum is that the trading range, the reaccumulation, is going to have an upsloping structure. And we could approximate the duration of the trading range based both on the analog supply and then on the PNF. I know that there was one of the questions that Troy was asking me before this session. So we were thinking a possible upsloping structure. We were talking about this in August of 2019. That's kind of how it happened. So I was very pleased with this analog. Then as we go into the high, and we are hitting, well, this is NASDAQ, but Russell S&P 500 was just slightly above 3,400 into 3,500. So we are in that target zone, and we are starting to break down. So this was an interesting call because it happened on Friday. This last day on the bar is on Friday. So what do we say on February 21st of 2020? A change of behavior is happening that is on the background of the climactic action, extremely overbought condition, shortening of the upthrust, and an overthrow. And you could see I'm using, again, linear regression line here from the beginning of 2018 formation. And that is suggestive that we potentially, also on the background of the increasing supply signature, which was the highest supply signature since the low in December of 2018, we could have a reaction. Now, I'm identifying here a potential target as 9,000, 9,200. So I'm thinking here at that time that we are going to have some kind of reaction down into this area, and then a reaction up before we decide what's going to happen next. We're going to go either into a trading range or we're going to continue to the downside. And then obviously, guys, what has happened. So that was the actual call right there at the top. This is the call at the bottom. So we already anticipating some bottoming. We just don't know exactly where it's going to happen. I mean, obviously, there are some PNF counts that we use, but those are more a guide rather than, a very linear way of looking where we should actually stop with the price movement. So we're discussing different type of scenarios, and this is tactically what we do, at Wyckoff Analytics using the Wyckoff method. What kind of best case scenario we're going to have? What kind of worst case scenario we're going to have of this unicorn market? I call the COVID-19 as a unicorn just because of the characteristics, velocity characteristics, the depth of the decline, and from where it happened. So we were discussing either a possibility of a spring or a possibility of the final capitulation as a selling climax. In both cases, anticipation was that there's going to be some kind of change of behavior that we first are going to observe on the intraday level. And this is where we want to catch our, reversal. This is where we want to start heavily establishing the positions. Although I was actually establishing positions to the upside throughout the whole structure, even though it was down sloping structure, there were a lot of elements of buying. The first came on the 12th, actually. Then the second one here. There was a little bit of buying right here. Then there were more buying here, and definitely there were a lot of buying here. So it's kind of like a trained eye, would see that buying through the whole structure. It would give you some kind of hint about the bias itself. I don't think it's going to be visible or that visible for the naked eye or for the amateuristic eye. You just really have to develop the way of how you observe the charts and what kind of deductive reasoning you apply in order for you to come up with the bias and the timing and the rest of it. Well, on that particular day when we had that move down, and we had the gap down actually into the Monday open, what do we observe? During the Asian and the European session, the price does not want to go down. This is strange. This is a different behavior. That already shows some bullishness. Then, before the US market, we have a very aggressive rally that shows a lot of elements of strength. So, another bullish sign on the intraday. As the US session starts here at the low, look at what happens during the US session. The test, higher test, even higher test. And we're just saying, that's it. From here on, we're going to go up, especially if we're going to overcome this resistance. And every time we're going to do this, in terms of the reactions, we look at the character, the texture changes, the structure changes, it becomes more of the bullish behavior on every time we see some kind of price action on the intraday. So that was the actual intraday call on that particular day. And then the rest is kind of like a history. It just kind of becomes very easy once we're in the uptrend. You can establish some parameters for your intermediate targets. So here's the intermediate target for the intermediate buying climax that we had prior to the final buying climax. We extract this information from the intraday data. We extract the information on the structure itself. Here is our change of character. So suggesting that from the trading range, we're now in the uptrend environment. So the uptrend was somewhat easy to go through. And there were a couple of spots there where, supply comes and we just, want to identify some kind of absorption of that supply on the recovery, on the confirmation, and then create new targets that are going to show us, some kind of higher objectives, and obviously keep in mind the all-time high. And I'm just showing you the progression of this analysis. So this was right before the actual climactic action was made. So we're still seeing, first of all, how the swing analysis is showing literally almost to the points where the new trading ranges are going to develop. And our targets are being hit and being overthrown in the channel where we have the overbought, overthrow condition into the climactic action. So we've talked about how the conditions deteriorated at that point, and we would be expecting some kind of reversal akin to what we've had in the previous buying climax. So just to kind of show you all of the analytical points here. Any questions, guys, at this point on the analysis? Mm-hmm. We do want to take profits at the meaningful stopping action. So for instance, this was a meaningful stopping action right here. And we do want to take the profit on the way up, or at least have some stop losses that will take us out organically out of that position, just because a change of behavior could be substantial, could have some, supply characteristics behind it. Also, obviously, if you trade stocks, that's going to be based on the individual, stock performance, not just, the index performance. But you could, have more complex stop loss strategies that would describe the volatility of the upside. That's number one. That would be based on the, let's say, index itself. If X happens in the S&P 500, I'm going to decrease or scale out my positions and so on and so forth. And obviously, we want to honor, those targets that are long-term targets and that are confirming long-term targets, because out of those targets, after those, we're going to have a much more meaningful reaction, and therefore we want to close our positions or scale out of those positions, take profits in a more meaningful way. All right. All right. Well, let's go to the next couple of slides. Again, a free offering for those of you guys who trade US stocks. Our students create a communal Wyckoff watch list that each week I go through and I curate and I sign off on that list. It's been relatively fun to go through that because we obviously been in the uptrend, so a lot of stocks are just showing a lot of bullish characteristics. But go to our website, find that list, or go to stock charts, find that list as well. Again, I don't have the time to explain how to do and how to find all of those, but you can figure it out. Another free offering is our weekly newsletter. This is basically, if you sign up for this, you will know exactly what's going on each week with our company. A fresh market update each week that we would publish, usually based on some tweets, any type of specials that are coming your way, any type of core courses that we have that are coming your way, communal Wyckoff watch list, any type of vlogs that we have, or blogs to that matter. So check it out and you can sign up on our website. All right, a trade example. Those are always exciting because, the question is always, well, the methodology well. You've been teaching it for a while, but how do you trade it? What are your results? I think it's a very valid question, and I love showing my trades to students. We routinely discuss students' trades and my trades as well throughout all of the classes. Why? Because this is where you learn. You learn not during the trade. You learn after the trade. You learn in the post-analysis of the trades, because as you accumulate trades and you accumulate your post-analysis of those trades, you start seeing the commonality of mistakes that you make in your trading. And this is extremely important to define the common mistakes and then put them somehow into the process in such way so that you would be reminded and be aware in the moment that, okay, I'm making the mistake, so therefore I need to exhibit a different behavior. Well, I'm gonna show you, usually I show my students, mistakes. That's just my preference. I don't know. I don't want to really boast too much about, the trades that are profitable trades. But, for this group, guys, I don't want to, show you mistakes. So therefore, I'm showing you a profitable trade here, which was kind of like a hybrid between trades, calls, and we have a segment here, anatomy of the trade, for one of our classes. And so we were trading Nova Deer. So based on the structure and identification of the spring and phase C, our first entry is off the test on the reversal. Our second entry, third entry, fourth entry, all on the points of the reactions. And there were a couple of actual trades that either our students, myself, or Bruce conducted in Nova Deer. So it was kind of fun, to follow that. I think Bruce has taken this piece somewhere here. I was taking this piece right here, and obviously our original calls also paid off in a big way. Then after the COVID reaction, these are actual trades that I was making. So just coming in and scaling in into the position. I don't show here the climactic action. There was some scaling out at around 575 because 600 was kind of like that magnet, the target. And also the behavior that was exhibited at that time reminded us of the same buying climax that we've had before on the same trajectory. So that was very logical. Yet, I'm still in this position because this is a long-term campaign position for me. So therefore, the majority of my position, the majority of the size is still there, and currently at 549 as of today. So a very interesting trade right there. Okay. Now let's go and quickly discuss, what we offer in terms of the courses and special events. This is where you actually, actively learn. So this is for active traders, for active students. I would definitely, just suggest that. So our core offering is 3 classes: analysis, execution of that analysis, and then application. So Wyckoff Trading Course Part 1, Part 2, and then the Wyckoff Market discussion that I conduct together with Bruce Frazier. Um, those are 15 weeks courses, and Wyckoff Market discussion is conducted each week. We also have so many on-demand classes. So this is just not, the extent of it. Definitely would recommend point and figure horizontal accounts, any type of, time frames that you use, swing trading, intraday, long-term campaigns. We have on-demand courses on scanning. We have on-demand courses on tape reading, on cryptocurrencies as well, with the Alessio and so on and so forth. You just have to go and check it out on our website. We have launched a certification, Henry O. Pruden. Unfortunately, Hank has passed away in 2017. So just to honor his memory, his contribution to the methodology, his contribution to our development, we've created this certificate of proficiency in the Wyckoff method. So you have to take, specific mandatory elective classes, and just to go through the whole process. So for those of you who are interested in a more formal Wyckoff education, definitely I would recommend the certification. And this is the last slide. This is something very exciting that's happening right now. We are recording this on October 6th. So this Thursday, October 8th, I'm going to start a course with the series #1 on tape reading. I'm going to go through the basics of tape reading, as you could use through my analysis. And as I go through all of these slides, I'm using a lot of tape reading techniques. And you have to be very, very versed as a Wyckoffian, on tape reading, in order for us to decipher what the price structure is, what kind of bias this price structure has, what kind of timing it's going to have, at which time the price actually will move freely out of the trading range. So we're going to start with the basics and intermediate concepts. We're going to do bar by bar analysis. We're going to talk about the laws of supply and demand, effort versus the result, effort versus the result being the main law, in my opinion. And then also we'll talk about the swing analysis, and we'll talk about identification of the strength and the weakness. We'll talk about how we apply tape reading in the context of the price, Wyckoff price structure. Extremely important, material there. We'll talk about the tape reading, which is based on the P&F and the volume signature, and also we'll touch upon some horizontal volume and price tape reading. All of our classes always are interactive. We always have drills and exercises. So for those of you who's going to come to our classes, that's what you need to expect. A bonus session with Gary Fullett. Check out his work as well. Highly recommended for those of you who are in tape reading. And obviously, I'm extremely excited to have David Wise. And for those of you who are not familiar with David Wise's work, go pick up his book, which is called Trades About to Happen. This is one of the best books on the Wyckoff methodology, or specifically on tape reading and any type of absorption techniques. So together with David in November, we're going to talk about intermediate and advanced tape reading concepts. We're going to talk about the original Wyckoff tape reading techniques. We're going to demonstrate, how we would do this on the P&F. David is going to talk about his Wise wave indicator and cumulative wave. We'll talk about the swing by swing and bar by bar analysis. I'm going to become a student with David. He's going to give me a chart, and I'm going to tape read and chart read that chart. So that is also going to be a lot of fun, and as usual, drills and exercises. And the last concluding part of it is going to be advanced Wyckoff tape reading with William Reardon. And William resides in the UK. He's a Wyckoffian. He is a kindred spirit, as I figured it out just recently. And we're going to go through a lot of tape reading of the S&P 500, oil, any type of futures that he looks at. This is going to be more of the intraday and short-term swing trading tape reading using multiple time frames. And as with David, I'm going to become a student, and William's going to walk me through the chart reading. So we'll do that, tape reading session again. Drills and exercises, as always, homeworks. As I said, I am, a passionate teacher, so I don't believe in slacking off. I don't believe in, unmotivational students. If you come to our classes, you're going to work, and that's the students that we want. We want you to strive to become better in the way how you look at the market, how you read the charts, and how you deduct what's going to happen next. So pretty intensive curriculum here for us, but again, extremely exciting. All right, and with that, guys, I think that's it for this session.
Awesome.
Absolutely, yeah. Mhm. Yeah, and whatever we do, we are an educational company. I mean, like literally, I take this very literally when we talk about education. We're not trying, to create any type of services that are going to be, although we do have, one or two services that would say like, okay, well, we see that there is a signal here, there is a signal there. We specialize on education heavily. So it is for people and for students and for traders who really, really want to acquire the knowledge and the skill themselves. And we're just going to help you out along the way. We're going to speed up your education. We're going to give you the shortcuts that we've learned, throughout, 20, 30, 40 years of us using this methodology. Absolutely. Yeah. And again, our purpose is not to be, as precise as like the last tick at the bottom and the last tick at the top. The idea here is to understand what bias are we in right now, the timing of when the price will start moving, and then we could scale in into this position in such way where we could still create a sizable position. So usually, when a person, a student would come to me and just say like, well, I want to be at the bottom. I want to capture that, within the last ticks of the bottom. Um, we can show you the techniques where you could have the same size that you would have at that place uh, in other places, but they will be at the places with already confirmed trend characteristics, where you don't have to guess 50-50, where there is some kind of edge. Yeah, there is a more confirmed behavior, but still sizing up the position you could do even at those spots as well.
Thanks a lot for joining us today, guys. We really appreciate your insights into the market and look forward to digging a little bit deeper into some of your materials. And hopefully we'll catch up again soon. I'm sure a lot of the guys that are listening in will be, asking when they might be able to hear from you guys again. So we do have tentative plans to do a follow-up to this series. So hopefully in a couple of weeks or a month or so, we'll be able to get you guys back on. But in the meantime, make sure you follow these guys on Twitter. What was your Twitter handle again?
At Wyckoff Analysis.
Wyckoff Analysis, and then also check them out on their website. And where can the guys find you on the web?
Yes, absolutely. So Wyckoff Analytics .com. Go check out our website, and you could just Google us, Wyckoff method, and we're gonna come up probably somewhere there on the top.
Okay, perfect. Too easy. And of course, we'll add all the links and everything like that in the description below. So yeah, thanks a lot for everyone for tuning in, and a big thank you to Roman, who's taken us through material today. And hopefully we'll be able to hear from Alessio soon on a little bit more crypto-specific updates. So we'll chat to you guys soon, and thanks a lot for tuning in. If you like this material, please share it with your friends. Give us a like or drop a comment below, and we'll get back to you guys. All right, thanks a lot. Tuning in.
Thank you so much, Troy and Kyle, and looking forward to future sessions.